When most people talk about property markets, they're talking about Melbourne, Sydney, or Adelaide. But in this episode, I'm going to be talking to you on a deeper level, helping you understand the markets within markets. And while a couple of markets in particular are shaping up to show some serious value, and on the adverse, why one particular market might be slightly overpriced. In this episode, I'm going to open up my thoughts about what these markets are, what's changed in these markets, and what's the opportunity here in 2025, and what's the potential opportunity in 2025.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
I'm going to discuss with you about these three markets that I've been wanting to tell you about. And that's very basic. It's actually the bottom end of the market, which are prices that generally sat between that $300,000 and $650,000 price bracket. The middle end of the market, which is where it sat from about $650,000 upwards of about $1.1 million. And then that top end of the market, which sat from that $1.1 million or above. Now, for this particular episode, I'm not going to talk about those mega mansion markets where it's the $2.5, $3 and $4 million or more. I'll reserve that to the people that can afford it, and best of luck to you. But what we've seen over the last number of years, especially post-COVID, has been the rise of the bottom end of the market. Now, traditionally, this was for people that were looking to buy their first property or wanting to, buy a property in a regional area to live in, or it could be even an investor that's bought their first property maybe to upgrade over time. But what we've seen through the rise of property professionals in the industry is that bottom end of the market become heavily saturated with people owning not just one, but multiple investment properties. Now, it goes back to that old saying, quantity versus quality, quality versus quantity, and I'll let you guys decide what's beneficial for you. But the bottom end of the market, with all the saturation that we've seen from a significant increase in property professionals over the last 5 years, has resulted in a much tighter market in that space. Quite often you'll hear buyers agents, or I'll hear my clients, or I'll hear people in the industry saying how hard it is now from a competition point of view to actually buy properties with a 4, a 5 or even a 6 in front of it. And that's because there's a complete saturation. That's because there's a huge amount of people entering these markets. Hence, we've started to see an increase now in what people are prepared to pay for the bottom end of the market. And we're starting to see bottom end properties which were selling for $2 or $3 or even $400,000 many years ago, now selling for 6, 7 or even 8s. I look at places that I know very well, like the southwestern suburbs of Sydney, traditionally always seen as the bottom end of the market, but quite often now I'm seeing prices in these markets sell for $700,000, $800,000, $900,000 or even $1 million in some circumstances, which really now means it puts it into the middle end of the market. So we're starting to see a convergence, and that convergence is leading now to the bottom end of the market really starting to become the middle end of the market, essentially meaning that we've got a bottom and middle coming together to make one market. And that's either a good thing or a bad thing, depending on the way you look at it. For me, what I see is what they call bracket creep or price creep. Now, traditionally, bracket creep is words used for the marginal tax rate. So being an accountant, I'll always try to find ways to bring it back to accounting. But traditionally speaking, as your income grew, you started to grow into the next tax bracket, moving from the 19 cents to the 30 cents, pay rises, or you get a new job, you move from 30 cents to 40 cents, you start to get promotions, and now all of a sudden you're paying tax at 47%. And that's very similar for the property markets as well, being the bottom, middle and upper end. Our bottom end of the market has got so expensive that it's now starting to categorize itself as the middle end, essentially meaning we've got really no bottom end for people to purchase at. And now from a comparison point of view, people start to say, well, hey, that property there is worth $1 million. This property here is worth $800,000. But that $1 million property, even though while it's more expensive, it's actually providing far substantially more value. It could have a $100,000 pool in it, a $150,000 kitchen in it, could have cabinetry worth $50,000 and could be in a block of land. So when you start to look at the value that these two properties side by side are providing. You've got one which is providing an undervalue in the sense for the spending of 800 grand, meaning, hey, this is well above replacement, versus a $1 million property, which traditionally sat in the middle of that middle market, now being undervalued in terms of its replacement costs. I've got a client just recently that I spoke to, and he was looking at selling his property for about $1.8 million. So we're talking about the higher end of the market. Now he believes, Jeremy, at selling at 1.8 mil, I'm actually selling this well above replacement value, because by the time I buy the land and build the house, I'm actually going to be ahead still. While he's looking at a property worth about 2.2, but to buy the land and build the house today, it's far substantially lower at 2.2 than it was for him to go buy the land and build the property, which would be worth 2.8. So you can see that with that $400,000 price difference, he's actually getting far substantially better value from a cost perspective if he was to buy that $2.2 million property, as opposed to where he's selling his $1.8 million property, where really the replacement cost could be much less. So coming back to our markets again, just off the back of that example, bottom end of the market really starting to ramp up, now converging with that middle end of the market, and this is where we're starting to see value. That top end of the market in some states, now I'm going to be bashing Victoria in this particular example, again through my own personal research and speaking with a lot of people that have boots on the ground in that state, they've actually seen that top end of the market, which was worth say $1.8 to $2 million, now come down to that middle to bottom end of the traditional middle market. These properties now worth 1.1 to 1.3. Now, I've heard this on many, many occasions, that a lot of these middle end properties that kind of reach the top end of the market have actually lost nearly $1 million in potential resale value. Now, I have never seen, and again, in one of my past episodes, I said this before, but I have never seen in my investment career, and especially investing in all states around the country, I've never seen a market come off by $1 million. And that's a market in general in a specific location. So again, when we're talking about markets within markets, we're talking about states, and we're talking now about that middle end or bottom end or top end of the market within those geographical locations. On the reverse, in that same state, we're starting to see the bottom end start to come up as more competition arrives, looking for those cheaper properties which were worth once a lot more. So where I'm seeing value at the moment, I'm definitely seeing value in that middle market when I'm comparing to properties that traditionally were in the lower market. So I haven't seen as much price growth, and that's very much due to people's ability to borrow money. It's become quite expensive for people looking in that middle market to buy property, because when they're trying to get that $800,000, $900,000, $1 million loan, their repayments are looking on an annual basis at well over $70,000 or $80,000 a year when you take into account principal and interest. So it's a lot of money. That's most people's net wage if we're looking at $100,000 being now the average gross income for an individual. Take away some tax, and really one person's whole net wage is purely going towards paying mortgage repayments. And that's not taking into account the cost of raising a family, putting fuel in the car, groceries on the table, paying electricity bills, which we all know is quite exorbitant even with the government relief. So it's important to note, and I'll reiterate it again because I really want to drum it through your brains, is that that bottom end of the market's seen a lot of competition, really started to go up. Not a lot of cheaper priced properties running around the country anymore that have good value, of course. Starting to enter into the middle market now, and that means the middle market is getting very much muddy with a lot of bottom end properties and also with top end properties. So it's really expanded itself out, and that's where we're starting to see good value. The top end, not traditionally what I talk about quite a lot, not traditionally what a lot of investors will buy, but myself buying in the top end of the market, I've seen less competition, I've seen much more price discounting, and I've seen property staying on the market for quite a long time. Doing a lot of my research in Sydney, especially around areas that had a 2 in that price, I'm starting to see those take much longer to sell. On average, from my own research and looking at the market and forming my own opinion, I'm starting to see these properties sit on the market for well over 3 months. Those properties, believe it or not, are getting transacted by real estate agents multiple times. And that means people signing contracts, people having to crash the contracts because of financing or potentially getting sweaty palms and backing out. And those real estate agents are having to sell the same property multiple times. So if you have the ability and you're looking at that owner-occupied property, especially in the Sydney market, that had potentially a mid to high 2 in front of it, you'll start to see that those prices are starting to get discounted. All those properties are staying on the market much longer, which means that it's now swaying in your particular direction. So as of the date of this recording being in the first quarter of 2025, you would have started to see a lot of media articles that have been released where we're not seeing the numbers that we saw 2 years ago, which was blowing everybody away, of double-digit growth, for the first 6 months of the year, or double-digit growth for even that month, or even high single-digit growth for that month. We're starting to see a little bit of a pullback happen in the market, and that presents opportunity. So it goes back to the old saying from one of the best investors in the world, Mr. Warren Buffett: be fearful when others are greedy, and greedy when others are fearful. If you've got a market that's starting its decline backwards, or a market that's not seeing heavy levels of competition, that could be a great opportunity for you to offer prices with inside your budget. So just to confirm again, and I want to recap on what we've discussed. We've discussed these 3 markets in the property economy. I'm not specifically talking about geographical locations, but generalizing the 3 markets. We've got our bottom end of the market, which has seen a substantial amount of increase of competition, which has moved that market to now almost be in, or if not in, the middle market category. We've seen that middle market category stay quite stagnant over the last 12 months and in fact widen to absorb a portion of the bottom end of the market, and believe it or not, to absorb a portion of the top end of the market. The top end of the market, for most people that can afford to buy those particular properties, we've started to see a cool down, less competition, and properties staying on the market for a lot longer. Now again, I haven't discussed about those $4, $5, $10 million plus properties. They sit with inside their own market. Those people necessarily don't need to sell and are looking to move their money to take on new opportunities that may arise. So I won't go into detail about that in this particular episode, nor many other episodes. But the 3 markets that matter to a majority of us invest in this country, the bottom, the middle, and the top, we're starting to see a convergence. We're starting to see a widening of the middle market, an increase of the bottom end of the market. And I believe the value now is at the top end of the market coming back down to the middle, and that middle end of the market, which is representing better value in some circumstances than that bottom end of the market. Now again, how am I looking at that value? Just so you understand my train of thought, I'm looking at that $1 million property that's jam-packed with $1.4 million worth of value of goodies versus that $800,000 property or that $700,000 property that's only jam-packed with about $600,000 worth of goodies. I'd rather be spending $1 million and getting $1.4 million in value than spending $800,000 and maybe only getting $650,000 to $700,000 worth of value. So I hope you understand now my opinion and my train of thought when I'm talking about the 3 various property markets. Again, not talking about locations, but the markets like the bottom, the middle, and the top, how they all start to move. And when that convergence is happening, you need to understand real value. You need to understand what level of goodies you're getting in that bag when you're purchasing that particular property versus something that might be quite cheaper, but has really risen over the last 3 to 4 years. Are you still getting that real value? My prediction is we'll probably start to see a flattening of these 3 markets as there's been a bit of juggling and movement over the last 4 years in very aggressive manners. But I do feel that top end will still continue to retreat. That middle end will still continue to broaden, which brings in a lot more properties from the bottom end coming up to middle and a lot more properties from the top coming down to the middle. So there's going to be a lot of opportunities for many people out there in 2025. Don't forget to do your due diligence. Don't forget to chat with your professionals, get as much information as data as you can, and happy investing for the balance of the calendar year. I'm Jeremy Iannuzzelli. This is what schools should have taught you. If you like this content that I'm sharing, please don't forget to subscribe on YouTube, or if you're listening to us on iTunes and Spotify, don't forget to hit that follow button. Thank you very much.